Hey, what's up? So I got a comment from a viewer that was asking about universal life versus index universal life. What is the difference between the two? And so I figured I'd put together a quick video breaking down index universal life, traditional universal life. Ultimately, what is the difference? How has traditional universal life evolved into index universal life? What are the differences? And ultimately, how does it impact your decision in what you are doing with your personal finances and the decision-making process about what kind of product should you buy to fit your needs and solve your problems. So look forward to sharing this with you. Can't wait to see you in there. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, we're gonna be talking about index universal life versus traditional universal life. What is the difference? And ultimately what I wanna do is I'm just gonna go through, I'm gonna break down and try to simplify all of the differences between traditional universal life and index universal life. And I'm gonna be real straightforward with you. There are not a lot of differences. There's a couple things that I wanna do right out of the gate here. And before I forget to do this, I just want to, I'm gonna go to my computer screen right here real quick. All right, so what I wanna do here is if I go here and zoom in a little bit, let's see here. If we go real close here, what we can see here, this is an income advantage IUL. This is actually the policy that MPI uses with them. And so you can see here, this strategy right here, income advantage IUL. Income advantage IUL is an index universal life policy that features flexible premiums to age 120, an adjustable death benefit, and increasing crediting options based on the performance of the market index. Now, this is where it's really important to see this. This index crediting feature gives your policy greater growth potential than traditional fixed interest universal life policies, right? And although your interest rate is tied to the index, your money is never actually invested in the market. Okay, so what does all that mean here? So what that basically is saying that the upside potential, downside protection story, they're mixing and matching both things. Like I know a lot of IUL agents like to sell on the upside potential of an IUL because of the market participation. But the bottom line is that illustration there, it says it was really, and this is all IULs, and I learned this from Bobby Samuelson, and it was awesome when I found the actual lingo in the contract to back it up, that all IULs were designed with upside potential compared to traditional universal life policies. It was never meant to be upside potential due to participation in the market. It was upside potential as far as performance goes compared to traditional universal life. So when I got asked this question about what's the difference between universal life, what's the difference between IUL, here's the deal. Let's talk about a little bit of the history of universal life. Universal life dates all the way back to like the late 70s. There's a couple little instances there. It's become popularized that E.F. Hutton really made universal life the foundational kind of first universal life product that became popularized and sold and took over a lot of market share in the 80s. And when you look at universal life, basically here's the deal. Universal life, let's just break it down like this. I'll go universal life here. And so I'm gonna just break this down. I'm gonna go to my monitor here. I'm just gonna pop myself up here so you guys can see me. So what we got here is universal life. What you have is you have a permanent like cash value. So we'll just say cash value. So you have some cash value functions going on because it's gonna accumulate cash value. You have what's called basically annual renewable term. I'm just gonna go ART in the, as far as the foundation of the policy insurance needs go. So you contribute to a policy, it builds cash value, the annual renewable term is done on an internal basis. And then what you have is you have the life insurance, which is kind of tied to the ART obviously. Oh, hold on one sec here. Insurance. And so I'm gonna write NAR. I'm gonna do that, net amount at risk. So this is the thing. So here, let's go back in history and think about universal life when it was supposed to be so good, why it became popularized, because the crediting strategy of universal life was based on the fact that interest rates were really high. So in the early 80s, they were able to run illustrative rates on ULs at 10, 12, 14% because of the fact that's where the interest rate environment was. Now, here's the problem. And I'm going to go here. So let's go. So when we had rates for ULs back then, like up at, let's say, 12%, what happened was when rates were 12% back then in say 1981, when they first got launched, and then what happened is the rates kept coming down in ULs. Why? Because of the fact that the interest rates came down in the stock market, or in the federal funds rate and all that stuff, right? So what happened was, as the market came down, so did as the interest rate market came down, so did the universal life rates. They had to come down too. But the problem was with that is that all the illustrative rates are based on current assumptions. And when you base interest rates on current assumptions with universal life, what happens is the net amount at risk, NAR here, was different, because when you ran these illustration rates and they assumed a 12% current assumption, right? When you have these illustrates at a 12% current assumption, and then the rates go down to 8 and 7 and 6, and ultimately by the 90s, they were down in the 5.5% range to 6% range. And that for a UL, you know, we look at that today and we're like, that's sustainable, that's livable. But the bottom line is they wouldn't illustrate that way today. And the problem was when they were illustrated at 12%, that, remember, we have these other features going on here. We have annual renewable term, and we have the cash value, and then we have the net amount at risk. These all play together. So what happens is when the policy doesn't perform according to the 12% that it was assumed to perform at in the illustration, every single year the net amount at risk here is higher and higher and higher. So what does that do? That makes the annual renewable term become more and more expensive, because the net amount at risk, it's a bigger spread. So if initially you bought $500,000 of insurance, that would be your net amount at risk, is the $500,000. As the cash value built, that net amount at risk would shrink. That would make it so the annual renewable term wasn't as costly, and it would be fine. But then as time went on, if the annual renewable term was more expensive and closer to that $500,000 range, and the cash value didn't accumulate fast enough, this is why people had to start writing money checks for big amounts of money to avoid their policies from lapsing. And that was the problem with universal life. So if you're seeing how I'm talking about universal life, and you're drawing a correlation to how you've seen me talk about index universal life, it's because, and this is why guys, you're seeing me say, you've probably heard me say this statement, you can't put lipstick on a pig, or I guess you can put lipstick on a pig, but at the end of the day, it's still a pig. And so that's all IUL is. What they did is they tried to put lipstick on a pig. This chassis of universal life is super dangerous. And so when somebody asks me what is the difference between IUL and UL, IUL is simply universal life with an option strategy attached to it. So rather than them saying, hey, we're going to give you a crediting strategy of 12% here, and it's going to follow the market or whatever, like, so they're going to say, we're going to take whatever you would get for a crediting strategy or crediting credit, and we're going to take that, we're going to buy call options with it. And then you're going to participate in the market through call options, and then your crediting strategy is going to be based on the performance of that call option. That's all it is. It's nothing more. Here's the deal. What is an IUL compared to a UL? If you went with an IUL and you went with the fixed crediting strategy, I got news for you. Now it's just a UL. That is just a UL product, pure and pure as it gets. And so that is the biggest difference. Now it becomes an IUL Because at the end of the day, it's still a universal life platform. It's a universal life chassis that everything's being run on. So it becomes an IUL as soon as you take the crediting amount. I don't like this color. I gotta go to white for when I'm writing stuff like that. You take the crediting amount, let's call it 3.5% right now, just for the sake of it. Or you know what, let's just go 4%, just because math is easier with 4%. I don't know why I always try to get fancy. 4% crediting rate, right? So rather than right now, if they were to say, hey, the fixed crediting strategy in your UL, IUL product is 4%. This would be saying, okay, let's take that crediting amount and we're gonna buy options with it. We're gonna buy call options with it. Not puts, but always call options. And so then with that, they participate in the S&P 500, and then whether that market performs well, goes up or goes down. If it goes up, you win. If it goes down, you lose. That's how you get the upside potential, downside protection. You can never lose due to market performance, but this is one of the most missold components of Index Universal Life right now overall, is the fact that you can never lose due to market performance. Well, guess what? No, of course you can't. It's a UL product. You're never really in the market. You can't really gain with market performance either. You're just doing call options. And if you don't understand options, you shouldn't buy this product. And so at the end of the day, what is the difference? This is the only difference. The only difference in an Index Universal Life and a Universal Life policy is the fact that they're taking your fixed crediting budget that they would credit you anyway, and then they're creating an options budget with it. And instead of crediting you that money on a guaranteed basis, they're allowing you to buy call options. Now, all the other smoke and mirrors, and I've got a lot of videos on that, and this is not the purpose of this video, so I'm not gonna go down this rabbit hole, even though I'm tempted to. The purpose of creating all of these different index strategies, proprietary indexes, the no cap indexes, all these different things. They've come up with all these different ways to make it illustrate a lot better. But at the end of the day, you can't draw blood from a rock. The impact that has on how the IUL perform has nothing to do with what the market actually does. It has everything to do with what the options market does. So it has to do with what's your crediting amount. So this is going to be number one right here, right? Number one. Number two is going to be options costs. So when you look at this, the crediting amount is what sets your options budget, right? That 4% would be, okay, if you got 10,000 here, now we got in cash value, we got $400, 4% for an options budget. Now the options costs have an impact. That $400 is gonna buy us options. How many options is it gonna buy us? What's the value of that gonna be? It's gonna be based on what are the cost of those options. Has nothing to do with what the index actually does. And that's why you'll see the upside, or the participation rates have the ability to be lowered and changed. The cap rates have the ability to be lowered and changed. The spread charges and no cap rates in no cap indexes have the ability to be raised and changed to your detriment. It's not because the insurance company is trying to make more and more and more money off your back, because that's not how this works. It's because they're trying to mitigate their risks and their costs, because they know that they can't draw blood from a rock. They can't pay you. So the thing that I find hilarious is everybody's just like, well, if the S&P regular index has a cap of 8.5%, well, let's just do a no cap index. Well, I got news for you. Like, if you do no cap, they're still gonna limit and restrict your ability to get performance in that, because the insurance company is not gonna just be able to pay you out of the general fund, because here's the deal. You still are dealing with the same crediting amount of $400 in this situation, even capped or no capped. It doesn't matter. You're still dealing with the same crediting amount and the same options cost. So at the end of the day, if you're doing it in the right index, which is S&P, and don't buy any of these garbage indexes, proprietary indexes, or anything like that, at the end of the day, you're dealing with what's the index, what's the budget, what's the cost, and that's going to be what impacts what the performance of that policy is. And this is why I always tell people, there's a lot of things they've done to make it look really fancy, really sexy, to be able to illustrate and perform. On paper, I promise you, IUL will look amazing. it will look like better than anything you've ever seen, especially when you start taking policy loans out and they have baked in 50 basis points of positive arbitrage. But the bottom line is it doesn't work that way. If it did, I'd still be doing it. I saw too many negative situations, negative consequences, and unfortunately, I still know too many people who are representing and selling this product that I care about, that I have, that I like, you know, and I'm hoping that these people wake up, see the light, and come around before too long. So if you have any questions, this is it. It doesn't get any more simple than this. It is universal life. That's why I always say index universal life is simply putting lipstick on a pig, and that pig is the universal life chassis, the universal life platform. And so to break it down, I'm gonna make it really simple. I guess you could have skipped all the way if you wanted like the one short here. What is the difference between index universal life and universal life? The only difference is that in a universal life, they're taking a fixed credit, they're giving it to you, and I explained how the universal life chassis works. And now with an index universal life, it's the same exact chassis, it all works the same way. They're simply taking that crediting strategy and they're creating an options budget with it, buying call options, and you're participating in the S&P 500 through the participation of call options. That's it. Nothing more fancy than that, nothing more sexy than that. I hope you understand it. If you don't understand that, don't buy it. If you understand that and you believe in it still, I guess I'd have questions for you on why or how you believe in that, but I would say you should feel good about whatever decision you make, because at least you're making an educated decision, and that's that. So if you have any questions at all, comment in the comment section below. I will do my best to engage with every single one of them. Till next video, have a blessed, inspirational day. We'll talk soon. See ya.